welcome back to the podcast. This is the Weekend Paycheck. I am expanding this podcast out onto YouTube, so we have some video format for this as well. So if you are joining on YouTube, thank you very much. Pleasure to have you. We are also on Spotify. We're also on Apple Podcasts, Google Podcasts, really anywhere you can watch podcasts, we are on. So whatever form you want, you kind of have at your disposal now to do whatever you want to do with. I'm going to be changing things up a little bit on this as well. I am going to be structuring this to basically talk about one topic per episode, ideally, that is important for the consumer to know about buying a house and getting a mortgage. Additionally, I want to cover some market updates for what just happened in the previous week and also what's going to be happening in the next week in terms of like current events. I don't have a crystal ball, so I can't say exactly what's going to happen. But using these things, we can, I think, lay out a little bit more of a roadmap to what might be happening the rest of the year, especially right now. It is currently February 26th, Sunday, 2023. So what might happen the rest of the year is, obviously, that's the big question. What's going to happen? I'm optimistic, but there's a lot of stuff kind of going on here now. I think what's going to happen with that, whatever happens in the next 60 to 90 days, probably closer to 60, is going to show us a lot of what might be to come for the next year. I know everyone's throwing the recession word around, or they have been for the past year or maybe even two, because everyone knew the Fed was going to hike interest rates to curb the inflation because the world was falling apart. We had COVID, all that fun stuff. And now, well, there's been a good amount of optimism since interest rates were going down in November or October of last year, 2022. And we saw a rebound for housing. Maybe a good thing, maybe not a good thing, at least in terms of like the short term. We're going to get into a little bit more of that a little on later. But for right now, the topic I want to cover today is going to be closing costs and discount points. I think a lot of people kind of understand, at least generally, what their discount or what their closing costs are. A lot of people do think, for whatever reason, like when I issue a loan estimate to them, that the closing costs are what a lender makes on you buying your house or getting a mortgage, which in a sense is partially true because we do have fees that, we have to charge just like anybody else would because we have to put food on the table and we have to keep the lights on for everybody. However, this is a minority of your closing costs. The majority of them are going to be a whole different slew of things. Homeowners insurance, taxes, you're looking at title fees. Are there any attorney fees that are in there? There are quite a few things. The appraisal fee is going to show up on there as well. A minority of your closing costs are actually going to be what the lender is charging you. But I think everybody thinks that it's what the lender is charging me because the lender is ultimately who issues your loan estimate to you. And nobody likes to go through and look at small nitty-gritty details of what their costs are composed of. They just want to see that end-all, be-all number, the bottom line, if you will, and just compare it to whatever they saw online or whatever. I think people fail to do their research or care to do their research. They fail to care to do their research or just take a couple of minutes to look at what is going on. And it's insane because they're buying houses. People are buying houses, and I don't know, not to say that this is you or anybody who's watching this, because if you are interested in this stuff, then likely you're the type of person to take a little bit more time to kind of look at the intricate details. But most people just want to know what they have to pay, what their payment is, and all that good stuff. And they'll just compare those two numbers that they're going to get, which is, your payment and your closing costs, with what another lender might, provide for you if you're shopping around. But what they don't realize is those numbers aren't always apples to apples comparisons. They don't necessarily know why, and I don't blame them for not knowing why. Why would you ever want to know anything about mortgages until the day you need to actually get one? In which case, then it is an extremely important thing to know. So being detail oriented, at least just try to be for at least a week of getting your mortgage. Honestly, it doesn't take much more than that. As long as you know what's going on with your loan estimate and you have a good idea of it and you ask a fair amount of questions, you're going to be fine. And if you're listening to this, you can arm yourself with information for when you do go out and get a loan. It's going to help you out quite a bit in the future. But closing costs, what are they? Obviously, they're the cost to get a loan and buy a home. Now, it's both of those combined. It's not getting a loan, just getting a loan, or just buying a home. Most of it is just buying a home stuff. There's title cost from the title company, right? We have title insurance. There's going to be homeowners insurance, taxes. There is a lender charge that's going to be on your loan estimate. But like I said, lenders have to make money as well. Otherwise, they would be completely out of a job. They can't work for free. So a lot of people will just take the closing costs they see and compare those. I've heard so many people who will say, Matt, your closing costs are high. Well, and then they send me a competing loan estimate for a different lender, and my origination charges are actually lower. My closing costs are higher because I've accurately estimated what their homeowners insurance and taxes are going to be. Aside from another lender who is inaccurately estimating this is one thing that you should be aware of as a consumer, is there are going to be lenders that are going to inaccurately estimate your taxes and insurance on your initial loan estimate. In other words, something that has nothing to do with the loan, they're going to make look like it's smaller so that the end number of what your closing costs are appears smaller, so that you think that that lender's cheaper, when in reality, that is not the case. Also, so you must be aware for that, because with a week or 2 weeks out, once you get your closing disclosure, your final closing disclosure, which is going to be within the week of you buying your home, you might get a copy sent to you probably, I don't know, maybe 3 or 4 days on the long end before your closing. But those are numbers that you should be seeing before you show up to the title company or the attorney's office or wherever it is you're buying your house. Your closing, those are numbers that you should be able to see and review prior to getting there. And a lot of people don't even do that. They'll just show up on that day and then they'll see the changes that have come, which could have easily been avoided. It's a joke, honestly, that this happens, but it's not an illegal thing, I guess. It's just, oops, I inaccurately estimated your costs. It doesn't serve you as the consumer, and it's a horrifying thing, really, because you could have been with another lender that was either more transparent with you, worked better with you, or had a better deal for you. But that better deal was hidden behind false estimates, discount points that were played with to get your interest rate down. That was a cost that you didn't know that you were actually paying. And was hidden behind a couple of other things on the loan estimate. So you saw lower closing costs and lower interest rate, when in fact that was just kind of smoke and mirrors at the beginning. And then again, once you do get your final closing disclosure, then you see the real numbers and you're like, oh wait, this is not what we talked about. Or a lot of people don't even notice it. A lot of people will just sign where they need to sign because they're happy about buying a home. So it's a shame that it does happen. It is a shame that it does happen. But it's just something you need to arm yourself as a consumer to be completely aware of, or at least somewhat aware of, or find yourself a transparent lender that is going to go over everything with you. When I go over my numbers with my clients, I sit down with them as soon as they get a property under contract, and I go through every point of the loan estimate with them. I'll be on that call with them for a good hour. They can rip off any questions they want to me, and I will go through every single line and section of your loan estimate so you can see every cost, what your payment is going to be, what is associated with your payment, what are your taxes, what are your homeowners insurance, and all that fun stuff. Last thing I want is for you to be unhappy at the end because I lied about your tax or incorrectly estimated what your taxes and homeowners insurance are going to be, and then oops, you hate me at the end of it. It's just not a good way to go about doing it. But you can't let transparency be fooled for a worse deal at the front. And it's so hard to do, I understand, because as a consumer, you're like, oh, I want to get the best deal for sure. This other lender is offering me an interest rate that's 1/4 of a point lower, and their closing costs are lower, boy, what a sweet deal. When I encourage you to just look a little bit further into it. I'm not going to have any snippets of like visuals of what a loan estimate looks like here. I think I'm at some point going to make just a YouTube video on how to read a loan estimate, what you should be looking for. It's going to be very, 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 very basic and general information. Nothing specific at all for sure in terms of anybody that I would never put information from a client that I would, out on the internet like that. But I will go over like maybe a public example or breakdown of what it looks like so that I can at least go through line by line kind of what those items are, or at least, the varying sections of them so you can see what it looks like and you see how to read it, because it can be very confusing to look at initially, but once you kind of just say, okay, this is what's going on this page, then it's very, very easy to read and you can see what's happening, behind the curtain of your lender a little bit more. So that's something to be aware of is taxes and homeowners insurance. And that's something that you as the borrower or the buyer can find upfront quickly. You just have to be aware of, you just have to honestly search, just look for it. It's not rocket science. You can very easily, especially with the availability of information these days, you can go on Zillow, and even they have really accurate estimates on what those taxes are, or they even have a lot of times just the real taxes from the municipality's tax website, which even then you can just Google your county, Google your county tax assessor's office, or tax bill lookup or something. You can Google really a whole slew of things, and your tax website's going to come up. Pull that up, enter in the address. It's going to be a really boring looking website. It's going to be horrible. It's going to be the worst website you've ever seen because none of these counties have updated their website since probably 2005. I have no idea, but it's not going to be like the easiest search in the world, but in a matter of 10 minutes, you'll be able to find it. Input your property. It is going to pull up the tax bill. You'll actually be able to see, it's public information, what people are paying their real estate taxes with. What people pay for their real estate taxes. So you'll be able to see directly what are the taxes on this property. Excuse me. Then you can get an accurate depiction of what those taxes are likely going to be. Okay? Because they're not going to skew, or they're not going to be very different from what you're seeing unless there are some sort of there's exemptions that you're going to be able to see on the tax bill for what the current owner is paying, and those could be, if they're a veteran, they could have that exemption. If they're a senior, they could have a senior freeze on their taxes, where you'll notice that the taxes are actually going down. There's a whole slew of different things, but and it's going to be a tax bill is not like a horribly cut and dry document to look at, but if you just take a second and just study that document, you'll be able to see what your taxes are likely to be, so that you can get ahead of that. Because not only are there your taxes that you pay on a monthly basis in your escrow account, assuming that you're set up that way, which there's really no reason not to be, you're going to have closing costs for what your taxes are for a certain amount of months, depending on when you buy your home and when your taxes are dispersed, to give you a cushion so that your escrow account has enough money working in it for when your taxes are dispersed. It's going to be paid automatically by your loan servicer through that escrow account, which is essentially how that works. And homeowners insurance is a part of that as well. If you want an accurate estimate on what your homeowner's insurance is likely to be, call an agent and they'll be able to get you something very quickly. That's not rocket science either. That's fairly easy and straightforward. Always best to talk to somebody rather than just kind of get a guesstimate or even just Google it, because you don't get charged for a quote. So you just tell them what the subject property address is, etc., and they'll be able to pull something for you pretty quickly. And then at that point, what your homeowner's insurance is going to be. So that is pretty much that for the most part. A lot of times I'll even estimate in a lot of areas anywhere from $100 to $150 a month in homeowner's insurance. And I would like to be more conservative if possible, because at least on the initial estimates, because I would like it if you conservatively were like, okay, I should account for this much money being needed to buy my house. And then when we get further down to the process, I would love it if those costs were lower than we initially anticipated, because you are much happier. You get to keep more money in your bank, and the world is just good. All is well. Rather than the other way around, I do not want to tell you that you have to pay more money because the initial estimates were inaccurate. It's not what I want to do. So essentially, those are a couple things that you need to watch out for in your on your loan estimate. A couple of more things that I want to cover here as well. It leads into discount points. Discount points are a charge that you can pay to buy down your interest rate. It's fairly straightforward. If I showed you a rate sheet, I would show you a whole bunch of varying interest rates going by an eighth of a point increments. So 3.125, 3.25, so on and so forth, all the way up. There's offshoot pricing as well, but generally your lender is going to have a set of interest rates within a reasonable margin that you can obtain. So with each one of these interest rates, there are costs that are associated with them. The one that you qualify for with no cost or very little cost, to where it doesn't make a difference, it could be $20, who knows, or a $20 credit to you. It's never zero, but it's like very close to zero. That's your par rate. It's basically just your regular interest rate that you qualify for. An interest rate that is lower than that par rate is going to have a charge to it where you can pay money to buy it down. This is called a discount point. The opposite of this is called a lender credit, where you're taking an interest rate that is higher than what your par rate is, because instead of paying money, you are now accepting money back at the time of closing to cover closing costs, etc. So it kind of goes in either direction, right? A lot of people typically will go more the discount point range because the amount of time people spend or intend to own their home or have that loan is longer than the threshold of when they'll likely recuperate those costs back. I don't think that's really what they're thinking of specifically. I just think they think, okay, yeah, I'm going to be in this house for, probably 10 years, 15 years, who knows? So they'll go that route instead of the opposite. Because there will be a threshold of time where you'll recuperate that cost and then just incur your additional savings every month thereafter. I don't know, probably maybe 4 to 5 years after your closing. So if you're getting discount points, I would say it doesn't make sense to own your home short term, which most people don't intend really to buy real estate short term unless you're flipping it, in which case you're not using traditional or conventional means of financing. If you are financing the property at all. But regardless, there are all these different charges associated with your interest rate, which most people don't know. So what they will see is when they go to apply with a lender, because a lender is not going to want to shell out a whole bunch of information to you, because as the consumer, having too much information at your disposal makes it very difficult for you to make a decision. This is just a fact. The more stuff you have to think about, the least likely you are to actually make a decision. So that's not necessarily bad. It's just bad when lenders take advantage of that. Because the last thing I want to do is put a whole bunch of options in front of you that are, there's really only going to be one option that's best for you. And it's going to be very easy for me as a lender to see that once I take an application, I look at your information, and I see what you're trying to do, and all that fun stuff. There's really only one option that's going to be the best for you. And that's the one that typically I will go with, because why would you go with anything that's less than the best for you? So if there's a whole bunch of information that's spewed out to you and you have a whole bunch of options at your disposal, like 5 different options, you're not going to be able to know which one to pick. I kind of lost my train of thought of where I was going with that, but I know that I do want to get into where when lenders issue estimates or even a pre-approval or whatever to you, a lot of times they're going to have an interest rate on them, especially in your initial disclosures. I talked about purposefully, incorrectly estimating taxes and insurance to make your closing costs look smaller. Additionally, what they'll do is they'll keep a tax proration off of your loan estimate, so that later on, when the rate is locked, they can put the discount points, the cost for that rate, on your loan estimate, which is what you're ultimately going to be paying for, and then they will take that tax proration and then they will add it in to hide all or a portion of the increase in cost for what your interest rate is costing you, without you ever knowing that you are paying for that, which can be a shady thing to do. It can be a very shady thing to do, because otherwise you as the consumer just thought that you qualified for a lower interest rate with XYZ lender, when in reality, a lot of times that's just not the case. Sometimes there are cases where you'll be able to qualify for a lower interest rate with a lender just because of how their system is set up, their back-end system, how they pay their employees ultimately, or the cost that they have, because there are these margins on these loans when they're bought and sold. The higher the margins are, the more money that the lender is able to make. And I'm not going to get horribly in the weeds of this. If you are interested in this, let me know, and I'll have kind of an episode on, or at least a topic of an episode on this. I won't get too in the weeds of it, but sometimes there are lenders that are able to compensate you with a lower interest rate because their margins allow for it, because of their business model. Most of the time, I'm talking most of the time, everyone is pulling interest rates basically from the same place. There's no secret. If there was one lender out there that was just offering ridiculously lower interest rates, then everybody would use them. All things held constant, that is, of course, because a lot of times with the unicorn lender that might be able to offer you an eighth to a quarter of an interest rate point lower, you're going to be sacrificing a lot of things for that. Because what you're likely doing is using somebody that is, I don't want to trash online lenders, but a lot of them are not great. They're call center environment people. They're not really, their level of expertise is very minimal, and because of this, and they're just handed leads from their company that they call, or they send out mailers that call into them, and their compensation is lower because of that, because they are not an experienced loan officer. They are, they're ultimately getting these leads, which is why their comp plan is lower. Their comp plan is, because their comp plan is lower and they're not getting paid as much on each loan, their margin, the margin for the lender, this is the company, for that loan is wider. So with that wider margin comes the availability for that lender to potentially help buy your interest rate down a little bit, making them a more enticing fit for you, at least initially. And then you're going to get into the weeds of it with that lender, and there are going to be a slew of problems. I do not even know how many horror stories I have heard, from the example I gave earlier of lenders inaccurately estimating closing costs to make theirs look better, not accurately qualifying the buyer up front, so that when they're a week or two outside of closing, they get some information because their processor or underwriter is now trying to finally approve the file, and they can't because something came up where the loan officer didn't correctly ask a question for. They don't have the proper documentation that they need, so they need to wrestle for that or whatever. Or like so many horror headache stories that come right before closing, and deals that blow up because people just don't qualify for loans that they otherwise thought they did, because their loan officer's job is to just basically take them, get the application, run them through a system, get initial documents from you, and then just push you down the line and never talk to you again, really. You'll be hard-pressed to be able to actually speak to that loan officer again, especially after 5. I mean, a lot of them will cut out at 5 o'clock, and you'll never be able to speak to them. So if you work a 9 to 5, that can be problematic because now you have to find time during your day, and you can't just call your loan officer at like 6 p.m. or whatever. A good loan officer will be available for you and able to be communicated for you. So know that if you are getting a lower interest rate and all else is held equal, you're sacrificing the quality of that lender and potentially subjecting yourself to an absolute nightmare for that lower interest rate, which if all goes well, not to say that it absolutely will, fall off the rails, but if all goes well, yeah, you close on your loan, you get your nice shiny new interest rate. Maybe you're better off for it as well. Maybe you're saving more money, and good for you at that point. But it's kind of like substituting like a good quality burger joint with McDonald's. You know what I mean? It's cheaper. It's not better for you in the long run, which is difficult to understand because you're kind of just assuming, as the consumer, at least right now, maybe watching this, you're just assuming it's just a lender. Like, how could I not just qualify and move down the line? There is a lot of gray area in this business in terms of qualification, and in a lot of circumstances, having a good quality loan officer is, I can't even tell you how important. But other than that, interest rates are basically being pulled from the same lender, from the same place for all these different lenders. And what a lot of people will do is play with these discount points, or at least put them on your loan estimate and never tell you about what those things are, inaccurately estimate the remainder of your closing costs that have nothing to do with that lender, so that when the real charges come in on your closing disclosure, now your costs are higher than they would have been if you went with a different lender that was quoting you a higher interest rate because they didn't play games with you. So you need to watch for the smoke and mirrors in the beginning. That kind of wraps up that point. I know it went a little bit longer than I wanted to, honestly, with that, but that kind of wraps up that point on that. Watch out for your smoke and mirrors. Don't just assume that your initial quotes are completely 100% accurate. Get a homeowner's insurance quote. Look at the tax bill for whatever property it is that you want to buy, and your life will be a lot better. Or at least try your best to find a transparent lender, which it can be very difficult to do. But look around and see what you can do, because it's I've seen a lot of stuff that I just wish I hadn't, or wish wasn't a regular occurrence in the mortgage industry. Not to say everybody's bad, but there are some bad apples out there for sure. Okay, well, let's get into some current events here. Last week, man, the past month here has just been horrifyingly bad for interest rates, I will say. It's been really, really bad. Not to say that you should panic or anything like that. I would assume that they would likely, I don't know if they'll come down here in the next month, or if they'll continue to rise, or if they'll just kind of consolidate where they are for the time being. If we look at what happened last week, existing home sales, and also, I mean, as of recently, the CPI numbers are higher than the Fed wants to see. Unemployment rates higher than the Fed wants to see, which is going to mean here that the Fed is likely to hike interest rates again here in the next couple of weeks at their next meeting by at least 25 basis points. I would not be surprised if they did 50 as well. And according to them, 50 basis point hike is still back on the table. So if you're looking to buy a house right now, I always kind of, I was going to think like you're marrying the house and dating the rate. You're not getting into something that you can't get out of with your home financing. You're marrying your house and dating the interest rate. So you can always refinance after in the event that you are comfortable with I'm not saying to overextend yourself by any means, but if you are waiting to play the market, there's a lot going on right now, and I would not encourage anybody to ultimately start day trading interest rates by kind of waiting. So if you do end up doing that, you might find yourself with a higher interest rate. And hey, maybe if you do, maybe things go your way and interest rates do end up coming back down. But my point is, if it's comfortable for you to buy a house, doable, and you want to do it and you found a house that you want to put an offer in on, I would encourage you to go ahead and do that. Again, if it's comfortable for you. And then when interest rates come back down, you can look at a rate and term refinance, which is ultimately just like redoing your loan with a lower interest rate, and then incur your regular monthly savings from there. I would not let a good opportunity pass because you're assuming that interest rates are going to be coming back down, which they ultimately may. I think by the end of the year they probably will. My optimism keeps getting pushed a little bit further down the line here because, I mean, these economic metrics that have been coming out in the past, week or 2 weeks have been good for they would be ultimately bullish for a regular economy if it wasn't for the fact that, the Fed is trying to keep the dollar from collapsing, and they do not want to continue to see the CPI in the threes. They want that down to the twos, or the inflation rate down into the twos. GDP came down in actually lower than the previous month, and the quarter, and additionally lower than was forecasted. Initial jobless claims are actually lower in the last week than they were the previous week, and the forecast had them going higher. So this is another thing. Like, hey, great for the jobs market, bad for what the Fed is likely to do in the future. We see core PCE coming in slightly higher than previously and slightly higher than the forecast. It's just these things. We have new home sales coming in at an actual for last month, for January, of 670K. It was forecasted at 620, and the previous month prior was 625. Yes, this is definitely to do with all the new contracts that came in on home purchases from the recent dip in interest rates from the peak in November and October, which is where ultimately we're kind of getting back to there right now. I mean, we're peaking out almost into the sevens. Average interest rate, as I'm reading this to you right now, which the latest numbers would have come out on Friday, the 24th, average 30-year fixed is looking at 6.88. Now, I'll never quote an interest rate to anybody on anything like this podcast or any social media or anything, so I want that to be clear. I am just reading off average numbers to you right now. I know it gets very dicey with the interest rates in terms of what you can and can't say. I'm just strictly talking about average metrics that I'm finding. This is on Mortgage News Daily as well, which is a great resource. I also like the Bloomberg Economic Calendar, which I would encourage anybody to look at for upcoming events. But interest rates are definitely heading back up, or at least they have been up until now. I don't know. They didn't want to reach over a kind of a ceiling of that 6.8 number. Now we're just kind of consolidating as we have been for the past, I would say week, maybe a few days, 3-4 days. So we will see if we will begin to go back down or if it'll go up more. I would not bet that they are going to I would not bet that they're going to come back down, especially given what the Fed is likely to be doing here in the very near future. But that's pretty much for the most part that. So a lot of good things that we've seen economically. However, bad for what is going in the market knows this too. At least most consumers generally do, or at least kind of understand it. Like, these are good things to see in a regular market, but right now we know that we need to go through a little bit more pain in order for things to kind of get back to where they need to be to keep the dollar strong and, that reserve currency of the U.S. dollar, keep that strong. Looking forward to this week, Let's see here. Sometimes there are events that I'm not horribly familiar with, so I will. This one actually is not in English, so I'm not going to read that one. Let me see here. That was core durable goods orders for January. This one's going to be coming out on 8:30 on Monday. 10 o'clock on Monday, pending home sales for January. Were forecasted at 1%. Previous was 2.5. The National Association of Realtors pending home sales report measures the change in number of homes under contract to be sold but still awaiting the closing transaction. The report excludes new construction. So we're seeing existing home sales. This report is going to be coming out on Monday, this is tomorrow, and I am actually very excited for this because this is going to be a big gauge on the housing market. We'll be able to see, are we tapering off from the spike in activity that we saw in December and January? Are we tapering off from that? Because if we are, we're probably going in the right direction. I don't think housing prices are going to decline either, by the way, because inventory is just so unbelievably low. There's just no way. There's no way that there's going to be like a crash like everybody thinks that there is. I think there's possible to be a decline or definite consolidation and lack of increased. I don't think equity is going to appreciate at a normal rate here for the next few years. Let's just say that. But in terms of a crash, you can't have it because inventory is just so unbelievably low. Inventory is so low. Builders ultimately are building this inventory. And you know, there's just so many people still wanting to buy houses, and there's a number of different reasons. Why inventory is low? I might do an episode of this next week for the topic, but there's a number of reasons why inventory is so amazingly low. Let's see. On Tuesday, the Consumer Confidence Report for February is going to be coming in. Confidence Board Consumer Confidence measures the level of confidence consumers have in the economy. When consumers are optimistic, they tend to spend more, which increases consumption and overall economic growth. A reading that is stronger than forecast is generally supportive for the U.S. dollar, and while a weaker than forecast reading is generally negative or bearish for the U.S. dollar. This, in a regular environment, would be true, although we do not want to see the consumer spending more money. If the consumer is spending more money, then that means the demand for the demand for prices of goods and services are going to increase. So we're looking to see consumers spend less money. So short term, if this number comes, I'm talking very short term, like within a week. If this number comes in, we might see a good. Honestly, it could kind of go either way, because maybe we'll see the stock market kind of rebound here a little bit. We saw another dip, as of really the start of February. From the start of February, stock markets were coming down. S&P has been coming down here, so it's possible. If these numbers additionally show, like if that number comes in where people are spending more money than is perceived good by the market, then I would definitely say we're probably going to continue to go down here, just because that means all roads for good economic activity right now lead to the Fed increasing interest rates to further pump the brakes. So we'll definitely see what happens with that. And then Thursday, the initial jobless claims is going to be coming out again here. Initial jobless claims measure the number of people who filed for unemployment insurance for the first time during the past week. This is the most timely U.S. economic data, but the market impact varies from week to week. So that will be a good. That's a good one to look forward to every week. I would say have that one on your calendar here. To at least be looking at. And it's so funny because as soon as these things drop, you'll be able to see they usually drop sometime in the morning, 8:30 a lot of times. So then you'll see pre-orders for the stock market tend to fluctuate. But once these things do hit, you'll see the market directly react to kind of what's going on here. Pending home sales is going to be the biggest one for this week. So tomorrow at 10 a.m. on Monday, the 27th, the pending home sales report comes in, and this is going to be a big one. We're going to be able to see kind of what has been going on, or what currently is happening with the housing market after this little spike that we've had. So if this number goes down, if pending home sales goes down, that's good, because that's what the Fed wants. If it goes up, we're going to be looking at further rate hikes here in the future. But that's pretty much that. I have to clean up how I do these market updates here for sure. I think I need to clean it up a little bit and do that a little bit better. But anyways, that is pretty much that. Look at your loan estimate, ask questions, find a trustworthy lender if you can. If you can't, then just make sure that you're asking a whole bunch of questions on what's going on with your loan estimate, so that you don't get swindled. That's pretty much it here for today. I'll be tuning in or sending another one of these out next week, ideally. But that's pretty much all we have for today. And we'll be able to review what is happening, or what will be happening here in the next week, in terms of these events here. We'll be able to see what's happening with pending home sales. Might be able to get a good glimpse on what's going on in the markets thereafter. The consumer confidence report is going to be another good one as well to see. Oh, the ISM manufacturing PMI, the Institute of Supply Management, Manufacturing Purchasing Managers Index report on businesses based on data compiled from monthly replies to questions asked of purchasing and supply executives in over 400 industrial companies across the United States. For each of the indicators measured, new orders, backlog of orders, new export orders, imports, production, supplier deliveries, inventories, customers' inventories, employment, and prices. A diffusion index is calculated by adding the percent of positive responses plus 1/2 of those responses Okay, I mean, that's just, yeah. It's a very in-depth description of what that is. We're gonna get a good look in on this as well, from the Institute of Supply Management. So that'd be very cool to see as well. Yeah. The PMI is a composite index based on the seasonally adjusted diffusion indices for 5 of the indicators with differing weights. New orders, 30%, production, 25%, employment, 20%, supplier deliveries, 15%, and inventories, 10%. So we'll be able to see where these numbers come in at. And again, everything seems kind of backwards these days. Everything seems kind of backwards, which makes navigating this. We're all kind of walking backwards. We're trying to, backwards is forwards here. And forwards will inevitably lead to backwards activity. But that's it for today. That is going to be it for this week. Again, try to get one out next week. I'm doing my best to get one out every single week. I've just been trying to get back into the swing of it. But thank you for tuning in. If you are still listening, if you're still watching this, very much appreciate you. Feel free to check us out on social media. I post videos all the time. I'll be making a couple of them here right now for this next week. So yeah, hopefully all this is helpful. And feel free to chime in as well. Leave a comment below if you're listening on YouTube. Would love to engage with you and see what you think might be happening here in the future. But that's it for now. Thanks for tuning into the Weekend Paycheck. And we will see you next time.